Cosimo, Senior Tax Accountant, for the T1 presentation.
So just to confirm, everybody has a copy of the slides and the rating tables and the corporate tax rate table? Nobody's missing it?
So you were employed in Canada, but you didn't live in Canada for more than 183 days. You don't own a dwelling in Canada. You're not a factual resident of Canada or a deemed resident. Then you don't owe taxes in Canada. So you would file, but based on like Canadian tax law, you have to pay withholding tax if you're an employee of Canada. So in that case, you will likely receive a T4 from your employer who's in Canada. And then what you would do is file a 115 return, and you would get all that withholding back because you're not subject to tax in Canada, because you're not a resident of Canada.
So, question is that if you are non-resident
Yeah.
and then you are withdrawing your RRSP, so you still don't have to file your non-resident tax return in Canada?
No, because you're not earned any income in Canada because you're not a resident of Canada.
But that is your income, RRSP withdrawal is your income,
Yes,
so you don't have to file tax.
you're only subject to the withholding taxes on
So
it.
that is only you just
On
pay-
investment income.
Whatever you pay withholding tax, you settle with that.
Yeah, so if you earn income from a foreign country, you pay non-resident tax,
Yeah.
right? So like same thing as like, let's say you own shares of Apple and you get the dividend income from Apple, well, that's foreign income and you'll notice on a slip, you only pay 5% because that's the withholding tax rate on foreign income between Canada and US, that's the agreement is 5%. So you only pay the withholding tax when you withdraw from your RRSP.
That's good.
That's if you're a non-resident.
Yeah, you're non-resident.
Yeah. Okay, so let's do another scenario. So in this scenario, Megan and her husband Harry are moving to Ireland so she can start a new job as a professor. Megan and Harry don't expect to return to Canada since Helen, should be Megan, has been offered the position with tenure. Should be Megan, but Helen will leave on February 1, 2019 to get a head start on her teaching term. So the names are all messed up, but Leo will stay behind for a couple of months and take care of the affairs in Toronto, where they live, and he will leave his job March 15, and he expects to find a job once he moves to Ireland on April 1st. So both of them don't own a home, but she has a large investment portfolio she inherited from her grandmother, and the portfolio includes only publicly traded companies and real property in Toronto. So question 1, when will Helen cease to be a resident of Canada for tax purposes? February 1st? Yeah. So like, let's go back. So she leaves on February 1st. Leo arrives in April 1st. So the answer is April 1st. Yeah, because her spouse was a significant tie, and he was still a resident until April 1st until he moved. So she would still be considered a resident until April 1st, even though she left in February. So yeah, so that's what she'll cease to be a resident the day that Leo arrives to Canada. Second question. So what are the tax consequences for her regarding the investment portfolio? So there's a deemed disposition at cost of all property owned. There's a deemed disposition at fair market value of all the property owned. or only the shares of the public corporation would be deemed to be disposed of, or only the real property would be deemed to be disposed of. Yeah, correct. So yeah, real property is not, you don't have to pay tax on any real property that you own in Canada until you dispose it. And then when you dispose it, you have to file a 115 return. Yeah, so that's just explaining exactly what I just said. So does anyone have any questions about residency? Any real life scenarios you guys have?
Can I throw a curve at you?
Yeah, okay.
This actual case, we've got a client who's a German national,
Yes.
gay male, comes to Canada, gets married, he's called Smith. Okay, so he becomes Mr. Smith at marriage.
Yeah.
The GDR does not have any facility to recognize gay marriages. So in Germany, he's still Mr. Jones. He always will be Mr. Jones. So now, when he leaves Canada, he leaves as Mr. Smith. And when he arrives at the airport in Germany, he arrives as Mr. Jones.
Oh.
In Canada, as long as he maintains residency, he is required to report his world income.
Yes.
And he does earn income in Germany,
Yeah.
significant income.
Yeah.
But he earns it as Mr. Jones. Okay, not as Mr. Smith. From a Canadian tax perspective, he doesn't earn any income, foreign income, at law. Morally, he does.
Yeah.
Now,
This guy's a smart guy.
so
Change
now,
his name, I don't know.
to add complexity to the issue, they both pull up stakes. They've now moved to Germany, but they still own real estate in Canada, which is rental income. And I can turn around and tell you that in this case, the rental income is not being reported anywhere because they're not filing in Canada. They consider themselves to be residents in Germany.
Yeah.
But in Germany, they're known as Jones.
Oh, okay.
Right? So they don't know about the Smith income.
Oh, gosh.
There are gaps at law that you will run into, and that's really what that case identifies. They are temporary gaps until the law catches up with our social changes
Yeah.
and the values that we have and that we want.
So that means that
That's a-
gay marriages trigger this kind of situation. But some jurisdiction allow it, some don't.
Yes, exactly.
Excellent, good point.
That's a personal integration issue.
Yeah.
That's good.
Okay, so now we're going to start talking about the voluntary disclosure, where you haven't reported a source of income, you haven't reported a foreign reporting form, and you've just become aware of it. And so basically, this program gives you a chance to complete the CRA. Under the old program, you could actually submit a no-name application, where you would submit a no-name application, you'd submit what happened, and they would actually respond to it saying, okay, you owe this amount of tax, and then you would accept it, and you'd pay the tax, and you'd be done with it, and you'd be on side, you'd be complying with the law. So that's the old voluntary disclosure program, which was actually an effective program. A lot of people were starting to come clean if they were hiding income, and it provided a chance for CRA to recover the taxes, which essentially was the goal of the program. And with the old BD program, there was a general program, and every application would usually go through this. There wouldn't be a separate program. And under the old program, I did a number of applications to the old program, and they were very lenient towards forgiving penalties and interest. And now under the new program, we've seen some changes under the leniency of penalties and interest. And under the old program, you could actually receive a notice of assessment from CRA and then pay the tax, but they also changed that in the update. So this was like pre-2018. Under the new program, you're actually not allowed to submit a voluntary disclosure application without paying the taxes. So on your application, you have to submit a check with it. And it's kind of contrary because you don't know what the final interest and penalties are going to be unless you have a perfect interest and penalties calculator. Okay. So there's 5 conditions of a valid disclosure. One big one is it has to be at least 1 year past due. And the payment, like I said before, has to be an estimated tax owing with the VD application. If you receive a demand to file from CRA for a late HST return, a late corporate return, that automatically excludes you from the program. The CRA already knows about it. And it must be complete. Any unreported information must be brought forward, and it can void the application if in any future times the information becomes available that we're not compliant. So under the new program, there's two programs. So the general program is similar to what the old program used to be, but I find that they're a little more strict with interest and penalties, so they're not going to be as lenient with giving forgiveness, so that's something to keep in mind. And under the limited program, there really is no, so like, the point of the voluntary disclosure program was to allow big corporations who haven't been non-compliant to come forward and pay the taxes. What they have done now is they've actually banned, there's no interest and penalty relief under the limited program. It's essentially just, okay, we're not gonna pursue you in court for gross negligence, which, to me, that's kind of there's a no point, no risk reward scenario.
So they won't send you to jail.
Yeah.
Tax evasion.
But CRA is not really that good at discovering.
We never heard anybody went to jail because of that.
I thought they did. 8 months.
So usually under the limited program, it's, if you apply through this program, you're actually, gross revenue is usually over 250 million, so we're dealing with large corps. Yeah, so there's no like factual basis. CRA evaluates each application under a case-by-case basis, and of course there's different agents that are evaluating the program, so results could vary depending. It's never going to be the same ABCD. And then these are the following factors that they consider. So usually as soon as they see offshore vehicles, there's going to be no forgiveness. Just pay the tax, company, the Panama Papers, etc. So they actually have a special program for GST and HST where you can be fully complete. So essentially, imagine you're charging revenue and you have to charge HST, but the actual receiver of the costs are just putting an input tax credit. You can file this and it'll be a complete wash. There will be no taxes payable. So in summary, CRA has made significant changes to tighten up the program. There's a certain form, I believe it's an RC 420 online. If you do a Google search and type up voluntary disclosure program, there's a folio on it that goes into it. So I've done a very basic one where the client hasn't reported T1135, which is a foreign reporting marketable securities. I've also done one where a real estate investment trust. So in short story, the beneficiaries of the trust, every time it's a real estate trust, so every time they generate funds to the trust, they issue real estate units, and essentially the beneficial ownership of the actual real estate properties changes. So in Ontario, under Toronto and Ontario law, you have to pay land transfer tax on this. So technically, every time there's a $1 change or a $1 unit issued, the beneficial ownership of all the real estate properties change, and these are for trusts that are over $250 million in value. The tax consequences of this would fall into the limited program, but all of these large corporations, because there's no interest or relief penalties, they actually have to pay a large land transfer tax, but they haven't reported it, and CRA will never catch on to it. So they actually haven't decided to report it. We just made them aware of the risk, and that's our job to do, and they decided not to proceed with it. So to continue to discuss income splitting restrictions. So I'm sure you guys have heard on the new tax on split income rules. So it's characterized as COSI. So back in the day, way before the introduction of the kiddie tax, a lot of corporations would split income with minor children. Under 18, they issued dividends to them, the corporate tax. What the government did was introduce the kiddie tax, so you can't pay dividends to children under 18, which that's fair. That should be permitted. And then the government decided to introduce a tax on split income, which is an extraordinary complicated set of rules that are tough to follow. what everybody suggested was just to expand the kitty tax from 18 to 24, which would be the simplest thing to do. It's very easy to understand. Because a lot of the times you get these professional corporations who are income splitting with a family. At times they'll have 3 or 4 children at university or just turning 19, and that's how they income split, and they can income split across the board. I had to actually deal with a client in a corporation, a professional corporation, that had huge accrued gains in their marketable securities portfolio. They had 5 children. They had lots of eligible dividend build up in the corp. So what they did, a common plan was, before this rules came into play, what they did is they sold all the securities in the corp. They bumped up the ACV and the value. They had huge gains. So what they did, they also have refundable tax in the corp. So they paid all 200K dividends to each child. They generate refundable tax, the eligible dividend, and it's all taking them into the RDPOH rules. And eventually, the children will pay variable tax on the income. So that's what essentially they're trying to close the loopholes on, which they did successfully. But you have to keep in mind, with tax and split income, it's just going to encourage people to retain money in the corporation and not withdraw dividends. And essentially, CRA will tend to generate low taxes on that. People are just going to retain the money in the corporations and keep the deferral going. So it's kind of a catch-22. It's either you income split with lower children, or you just retain the money in the corp. So that's not really what was considered.
But can I just
Yes.
inquire there? I thought within professional corporations, the amount of interest income you were allowed to earn on monies retained within the corporation was going to be restricted. You could earn $50,000 worth of interest before it began to get
Yeah,
taxed.
so we actually have slides on the passive SPD deduction in the corporate section, so we'll touch on that there.
Okay.
So yeah, that's actually affecting a lot of professional corporations in general, because it's a 50,000 passive investment limit for all the associated corps that are claiming a small business deduction. So it's a big rule that's affecting a lot of companies, and they're strategizing around it. So what type of income is subject to the expanded TOSI rules? So basically, any dividends or shareholder benefits conferred from private corporation shares, any income received from a partnership or trust where the income is derived from a related business, which is the definition we will describe when we get to the TOSI's flow charts. Income in respect of debt obligations, so any interest income, taxable capital gains from the disposition of certain properties. Something that TOSI didn't touch on is actually the advantage of using a trust and using a lifetime capital gains exemption through a trust, which is still perfectly fine, which is the common family trust structure. That's one of the main benefits of it, and we'll touch on that in the corporate side. So applying TOSI, so what you have to do to analyze tax on split income, it's a certain number of tests. So, and you're always looking for an out. So if you need a definition of an out, you're okay. And usually we look at that, and most people are specified individuals if you're resident in Canada, so you satisfy that test. And then if the income is split income, so if any of the income is classified under these definitions, it would be classified as split income, and then you're looking for another out, a specific inclusion. And then what amounts qualifies for an exclusion? It's considered an excluded amount and not subject to TOSI. So these are some of the excluded amounts that people can get around. So the CRA has said if at any time in the past 5 years or at any 5 years period in the corporation, if you've worked at least 20 hours per week for 5 years, that counts as an excluded business. So how they're going to prove that, I have no idea. We have no idea how they're going to do that. I guess you're supposed to keep a log for historically how long you've worked in the company. Maybe they're going to analyze your T4. We haven't seen anything yet for them to analyze the situation. They've also deemed an amount as a safe harbor return. So for most private corporation shares, you're paying nominal value for the shares. You're paying $10, $100. What's deemed as a safe harbor capital return? How many hours you put in the corporation, 5 to 8% dividend rate? We have to get some clarification from CRA on these points. So this is a little flow chart that we have. This is from Thomson Reuters. We found this is a pretty good flow chart. So you can go through, and this is how you really should analyze TOSI. So are you a specified individual? So you go through that test, and then you just keep testing yourself. So yes, you drop to the next box. You have split income, yes, drop to the next box. If you have an excluded amount, So if you have split income, you have an excluded amount. For an example, if you are under 25 years old and your parents passed away and you receive the property, that income is exempt for the time that you're under 25.
Another exemption is, if your spouse is 65 and over, you're allowed to pay dividends to your spouse. That one, they haven't subjected that income to TOSI. But if, the spouse is under 65 then, and any income paid to the other spouse who is not working at least 20 hours in the business and never has in the past 5 years, or didn't contribute any capital to the business, then that any dividends that were paid to that spouse, those would be subject to TOSI.
So I have an example where a colleague of mine actually, so we determined that it was tax on split income. So the client just wanted to come forward, pay the tax at the highest rate and get it over with. So we actually called CRA, and it was, I believe she called 3 times, and the agents had no idea how to assess or like accept the resignation that it was tax on split income, and that's the assessment. So then she kept calling. On the 4th time, they put her through to a senior agent, and even the senior agent was still a little perplexed and didn't know how to deal with it. So she took her name down, called her back, and eventually agreed, okay, yes, this is tax on split income. We're going to send you a notice of assessment. So even CRA still doesn't know how to deal with this, and it shows how together the government and CRA is. There's a little bit of a disconnect of how they're actually going to enforce the laws and what they're putting forward. So it's tough to enforce, and this would have been way easier if they just increased the kiddie tax from 18 to 24.
Yeah.
So we have another example. So basically, there was a professional corporation where there was 4 shareholders. Essentially, there was the 2 children that got input into the corporation when it started, and the 2 parents were earning fees. There was a medical professional corporation. Each of the individuals technically had 25% interest in the corporation. The husband was earning more fees than the wife was in the corp. So, and then at one time she stopped working in the corp to attend to family matters. So what we looked at is how much effort did the wife put in any previous 5-year period? Was she working at any time for 20 hours a week in any of the previous 5-year periods? And we determined, yes, she was. So we were able to pay her a safe harbor dividend of, let's say, 4 or 5% a year and split income, essentially. But if any of the income was paid to the children, then we would have determined that was split income. One way you can get around it is paying T4 salary, but make sure you just determine what's a reasonable amount, because they could look at that as well. So does anyone have any questions on this flow chart and tax and split income?
Suppose you have a sole proprietorship.
Yes.
Okay, you have maybe $500,000 income, and you have 4 children, and you say that they are helping the business,
Yeah.
and they issue T4As in the end of the year. Is it allowable?
As long as it's reasonable. So like, I've seen people where they give their spouses $2,000 and they say that it's for bookkeeping services or admin services. As long as it's reasonable, and there's no way they can come at you and say, if you're paying.
But anyway, they are paying tax on their T4s
Yeah.
or T1, so I don't think CRA will be working.
As long as it's reasonable, like you can't pay them 75 grand or 50 grand for saying you do bookkeeping once a week. Just keep it, you have to use your judgment.
Mostly small businesses run by family.
Yeah.
They are obviously whole family is working in a small business, so they issue them T4 or T4A as a reasonable amount. Should not be a problem.
Yeah.
Yeah, as long as it's reasonable.
Yeah.
If you pay them too much for that job, and they'll assess reasonable, like what is the market rate for that job?
that particular-
What are they doing, and would you pay a third person? Because you're dealing with arm's length individuals, right? So Sarah will look at, okay, what would you pay a non-arm's length person to do that job? Would you pay someone $75,000 just to do bookkeeping? CRA might come back and say that's not reasonable, and then they'll deny that deduction that you took in the business.
But the overall calculation, if they issue T4 slips, in corporation, because they will reduce their income,
Exactly.
by that, and they will reduce their corporate tax.
Yeah.
Yeah.
So I think corporate tax is less
Yeah.
than what they will pay on the personal income. So CRA is
Yeah,
the
if you're
advantage.
issuing a $24,000 T4, you're not gonna be paying much tax anyways.
Yeah.
No, but suppose they are issuing T4,
Yeah,
so the corporate, the CRA is in advantage,
yeah.
than the corporation.
Mostly these kind of rules are for high income professionals like a lawyers, doctors. A lawyer making $1 million, so he has to pay tax on $1 million. So what he does is he gives the $500,000 or 200,000 to his family member to split. So that is what the TOSI is about, to stop that kind of loophole. So then they cannot split the income and pay less tax. For small businesses, $20,000, $30,000 T4, T4A, CRA doesn't care about it, and they don't want to really enforce that now.
Yeah.
That is where the big chunk is. Those doctors and lawyers and surgeons who making millions of dollars, that's where the problem is.
And I think, if you think about it, so the small business rate now is 12.5%. So if you were to issue a T4, to say a low-income individual,
Yeah.
say that your spouse is not earning income, 23,000, you actually, CRA would be out, I think. I think you would receive more corporate tax than they would personally.
I think CRA has put criteria, you know, in issuing the review letters, you know. And I think they already calculated that is in CRA's advantage or disadvantage, you know. The criteria they have established, you know, they have a program. You know, how many thousands of letters they are issuing based on the criteria. And the basis is that it's CRA losing or they are winning.
Yeah. I've seen a review letter for $1 actually. on LinkedIn.
$1.
Yeah. It's just a computer automated program. It's not someone
Oh
actually.
yeah, but if not on the correct criteria,
Yeah.
okay, it will show that.
Okay, so this is the flow chart that we found very useful, and then we have some examples here.
Okay, so let's go through an example of proceeds. So here in this example, you have Mr. and Mrs. A. They have a 35% share each in Corporation A, and the other 30% is owned by a family trust, in which the two adult children, both over the age of 25, are the beneficiaries of this trust. Corporation A operates